Hi everybody and welcome. My name is Maria Kringle and I manage our SMSF division here at Saward Dawson. It's good to see so many of you here. If you have any questions from anything we raised today, can you please add them to the Q&A and we'll come back to you after the session. Now this is our disclaimer. And as it says, we'll be providing factual information only today, which doesn't take into account your personal circumstances. If you can all make sure you have your microphones switched off, we'll get started. Today, we're running through what happens to your super in retirement and consider if the planning is actually over. There aren't very many things in life that you can set and forget, and super is no exception. As with all things financial, changes continue. So while you may have stopped working, you still need to take an active interest in your savings, even those in superannuation, to make sure that your requirements continue to be met. Unfortunately, there's no way of avoiding jargon when I'm talking about super, but I'll do my best to keep things simple and easy to follow. The specific things we'll look at today are understanding your super account, so that's the components that make it up, possible legislation changes, assessing if super is still right for you, assessing how you withdraw your super, and whether contributions can still be made. And then we'll also have a look at how super fits in with your estate planning. Now, there are different aspects of your super account that you should know about. Firstly, how is your super invested? There are different options available, ranging from mostly invested in cash and fixed interest, right through to being mostly invested in growth assets. Obviously, the return on investment is different depending on which option you choose, with cash investments providing a lower rate of return and low volatility, and high growth assets providing a higher return with the possibility of higher volatility. There's no correct choice here, as everyone has a different appetite for risk. If you don't know how your hard-earned superannuation is invested, though, you may be in for a shock if it's not in line with your risk appetite. Secondly, one of the things that impacts on how long your super savings last is the fees that you pay. These vary from fund to fund, and some are a set dollar amount while others are a percentage of your balance. It pays to review and compare with other fund options to be sure you're comfortable with these. Do you still hold insurance in the fund? Generally, within super, total and permanent disability cover ends around 65 years of age and life cover around the age of 70. Depending on your personal circumstances, you may want to adjust the amount of cover or cancel your cover altogether. As the cost gets higher as you get older, your decision regarding insurance can have a big impact on your super savings. You need to be sure you have sufficient to meet your needs, though, before cancelling anything. It's something that our wealth advisory team can assist with is a review of your insurance needs. Also, consider how your fund is performing. Does it provide a good rate of return in comparison to other funds invested in the same way? And are you happy with the customer service that you receive from this particular fund? They do vary a lot, and particularly as people get older, they find it maybe a little bit more difficult to deal with online options only, which is the way everything is going. Now, it's also a good idea to have a look at the most recent superannuation statement from your fund to understand what makes up your super balance. Identify the tax components, and these components may have an impact on tax payable when your super is paid out as a death benefit. The taxable components of your super balance consist of all the concessional contributions made to the fund, that is, super guarantee, salary sacrifice, and member deductible contributions, plus the growth in earnings over the life of your pension account. This category, that's concessional contributions, can have two parts. The majority of people have taxed elements, which means that tax has been paid when the contribution was made to the fund. But some who are employed by government have untaxed elements. Untaxed elements may be taxed at a higher rate when paid as a death benefit. The tax-free components arise from non-concessional or after-tax contributions that have been made during the life of your account. No tax is payable on these if they are paid as a death benefit. You'll already be aware that governments change the rules regarding superannuation from time to time. Even when you've entered retirement, it is to your advantage to stay informed about any legislation changes that might affect you. Your super fund will advise you of these as they occur, so continue to read the correspondence you receive from them. If you have a self-managed super fund, your accountant will provide this information. For example, currently there is a major change on the government's agenda, but which is not yet legislated, for people with super balances above 3 million. Being aware of changes may allow you to take action to mitigate any impact. This change got through the lower house but stalled in the Senate, and when the election was called, it lapsed altogether. The Labour Party is still showing the impact of this new tax in their forward estimates, though. It is definitely not gone yet. As you use your superannuation during retirement, and with the age pension thresholds increasing each 6 months in line with CPI, you may become eligible or entitled to the age pension at some point in the future. Income and asset tests both apply, and details can be found on the Services Australia website. You may also be entitled to the Commonwealth Seniors Health Card. The income thresholds are updated once each year in line with CPI, and there is only an income test for this card. It provides cheaper prescriptions and some other health benefits. Now, no one will tell you when you become eligible. You need to be aware of these options yourself and review what the thresholds are as they change and your super reduces over time. Now, whether you leave your super in the super system or withdraw it is something else that should be considered every few years, particularly if your super balance is reducing. The things to consider are identify what your taxable income is outside of super. If this is negligible, you may get a better tax outcome by withdrawing all your super and investing in your own name or with your spouse. This will save you the fees within the super fund and simplify your financial position. A couple who are both over age 67 and are eligible for the seniors and pensioners tax offset can earn over $60,000 between them annually before paying any income tax. One of the benefits of super outside of an SMSF is that someone else is doing the investing for you. Now, another thing to consider is your super fund balance and the components. If you have only taxable components in your super balance and it will be paid to non-tax dependents, for example, adult children, after death, you might save considerable tax if you withdraw the balance from your super during your lifetime. There are trade-offs with this, though, as no one knows how long they will live. For example, if you did this and then lived for another 20 years, this might not be the best option for you or your family. Another thing to consider is your age. If you're finding it difficult to manage your super and don't have any family to assist you, you might want to simplify things. Now, there are pros and cons to consider for all of these, and it very much depends on your individual circumstances. Our wealth advisory team here at Saward Dawson can assist you with a review of your circumstances. There's different ways that you can withdraw your super. When you retire, you can choose how you want to receive it. You don't have to stick with the decision you made at retirement, but can change things if you want to. The options available to you are leaving your super in accumulation phase and taking lump sums when you want them, or moving your super to retirement phase by commencing an account-based pension. You could also take a combination of the above if you wanted to. If you choose to leave your super in accumulation phase, lump sum withdrawals are available to you, and if you're over 60, these will be tax-free in your hands. The income earned in the fund will, however, still be taxed at 15%. It's also important to understand, excuse me, that any income earned will be added to the taxable component of your accumulation account. So while it's an accumulation, the taxable components grow. As mentioned earlier, if you're over 60, the withdrawal itself won't be taxable in your own hands. But if you don't spend the money and instead invest it in your personal name or leave it in a personal bank account, any income earned will be taxed at your marginal tax rate. If you choose to commence an account-based pension, excuse me, which moves your super to the retirement phase, the income earned within the fund will not be taxable, and an annual minimum pension withdrawal will be required to be taken based on your age at commencement or at the 30th of June of the prior year. Also, when you commence an account-based pension, you can make it reversionary or non-reversionary. Reversionary means that it will automatically continue to be paid to your spouse after you die. When a pension is commenced, the tax-free percentage of the entire account is calculated. Any income earned within that account is allocated in the same proportions to your tax-free and taxable components. This is very different from the treatment for lump sums, which, as I mentioned, are taken from an accumulation account and all the income is added to the taxable component. As you can see from this table, the minimum pension rates increase as you get older, right up to 14% from 95 plus. These are just the minimums required. The additional amounts can be taken in any year, but remember that this will impact on how long your super lasts, particularly if you take a lot extra in the early years of retirement. Account-based pensions are designed to fund your retirement. They're not supposed to be a means of passing wealth to the next generation of your family. In practice, however, where large super balances are held and the money is invested well, there may still be money left at the end of your life to pass to your beneficiaries. Just because you're retired, it doesn't necessarily mean that contributions to super are no longer available to you. You may still be working in a part-time capacity or be under age 67. Any new contributions must be made to an accumulation account, though. You cannot directly add to an existing account-based pension. Also, the age and cap limits still apply. Firstly, we'll look at concessional contributions. The annual cap is $30,000 for both the 25 and the 26 years. Super guarantee can be made at any age. salary sacrifice contributions can be made up to age 75. Prior to age 67, you can make member concessional contributions without meeting a work test. For ages 67 and up to 75, member concessional contributions can only be made if a work test is met. That's working 40 hours in 30 consecutive days in the year the contribution is made. This, a summary of the rules for concessional contributions is shown in this table. You must also have sufficient personal taxable income to make claiming a deduction for superannuation contributions of benefit to you. If your marginal tax rate is below 15%, a concessional contribution will increase the overall tax you pay and is of no benefit to you overall. Now, we'll have a look at non-concessional contributions. The annual non-concessional cap, that's after tax contributions, is currently $120,000, and you have an option to also bring forward 2 more years of the annual cap and contribute up to $360,000 in 1 year. This is dependent, however, on what your total super balance was, which we'll look at in a minute. These contributions are from after-tax money and are not taxed when received into the fund. Since 1 July 2022, so that's quite a while now, individuals can make non-concessional contributions up to age 75 without meeting a work test. This can provide individuals, even those who have been retired for a number of years, with the option of getting money into super and reducing their overall taxation. It can also allow members of a couple to even up their super balances, move more to a retirement phase, and also to reduce the taxable components that might one day pass to their adult children. If you're under 75 and are interested in a review of your superannuation, our wealth advisory team would be able to look at this for you. The general transfer balance cap, currently 1.9 million, will increase to 2 million from 1 July 2025. This cap also restricts how much can be moved to retirement phase. It also affects other rules, including the total super balance rules that apply when making non-concessional contributions. This table shows how your total super balance impacts on eligibility for non-concessional contributions, and also who can use the 2-year bring forward rules. As you can see, a non-concessional contribution cannot be made at all in 2025 if your member balance was over 1.9 million at the 30th of June 24. This cutoff increases to 2 million at the 30th of June 2025 for the 2026 year. Now, I'll be covering all the contribution rules in more depth in our webinar on contribution options, which is scheduled for the 30th of April. Watch out for the reminder if you haven't already registered. You can check what your personal transfer balance cap is by looking under the Super tab on your MyGov account. Your total super balance is also recorded there. Now, a special contribution that's available to people from age 55 onwards is a downsizer contribution. This falls outside the normal non-concessional contribution caps, and a special form needs to be lodged with your super fund to notify them before or at the time that the contribution is made. Downsizer contributions not only fall outside the normal non-concessional contribution caps, but there is also no upper age limit for making these contributions. Individuals must be over 55 at the time of the contribution and must have owned the home that has been sold for more than 10 years. The contribution is a once-only amount and is capped at a maximum of $300,000 each for a couple. Actual cash contributed can be from anywhere, and there is no need to physically downsize the home, but just to sell the home. I'd recommend seeking advice before undertaking this type of transaction, as the timing requirements are very strict. Now, one of the major things in retirement to consider with your superannuation is how it fits in with your estate planning. As mentioned earlier, there is a cap on how much of your super you can move into the retirement phase. Currently, the cap is 1.9 million per person. This is called the general transfer balance cap. It's indexed in line with CPI in $100,000 increments, and it will rise to 2 million from the 1st of July 2025. The Taxation Office keeps a record of how much of your transfer balance cap you've used. If you have used the entire amount available at any time, you will no longer be eligible for indexation. If, for example, you've used 75% of the transfer balance cap and then indexation is applied, only 25% of the increase in the cap will be added to your personal transfer balance cap. If you want to check what your cap is, it's available on your MyGov account under the Super tab. As mentioned earlier, to maximise the amount a couple can have in retirement phase, it can be beneficial to withdraw a lump sum from the higher super balance and make a non-concessional contribution to the spouse with the lower balance. This may mean they can both move all of their super to retirement phase. It can also even up their balances, which can provide estate planning benefits in the future. I'll run through the estate planning considerations next. It's always important to review your estate planning regularly or when something in your circumstances changes. Regular review of your wills and power of attorney, maybe every 5 years, is important to ensure that your current wishes are met, all of your assets are covered, and that the executors you have appointed are still appropriate. Some people don't realise, but your superannuation doesn't automatically fall under your will. It will be up to the trustees of the super fund to decide how to pay any death benefit unless you have provided them with instructions. Where no instructions are given to them, they are required to look for dependents, and this process can delay the payment of the death benefits. There are a number of ways of providing instructions to the trustees. A valid, binding death benefit nomination must be followed by the super fund trustee. Again, it's important to review these regularly. If you want your super to fall under your will, you can direct your super to your legal personal representative, or your estate. In most funds, other than SMSFs, a binding death benefit nomination needs to be updated every 3 years, so this must also be monitored regularly. You may also wish to get some legal advice and talk to the solicitor that's prepared your will so that the binding death benefit nomination ties in with what your overall plans are. A non-binding death benefit nomination informs the trustee of your wishes, but as the name suggests, is not binding. The trustee must still look for dependents that may have a claim on your superannuation assets. I mentioned earlier that when you commence an account-based pension, you have the option of making it reversionary to your spouse. This can be a good option in some circumstances, as the pension will continue to be paid. It will be just a matter of providing the trustee of the super fund with a certified death certificate and any changed bank account details. which can make it a bit easier after the death of a spouse. Now, there's a bit of a sting in the tail and when it comes to superannuation death benefits. This is where the impact of the tax components mentioned earlier comes into play. Under the superannuation laws, your superannuation can be left to your legal personal representative, your estate, or to one or more cis dependents. The tax law includes the same definition of a cis dependent, but it also has another narrower definition of a death benefit dependent. It is this narrower definition which is used to determine the tax that is payable on the death benefit. This table shows who cis dependents are under the super law. It also shows the narrower definition of who death benefit dependents are under the tax law. There are only two differences between the two columns. The first is that a former spouse cannot be directly paid your super. If you want super to go to them, you need to pay it to your estate and include instructions in your will. They can receive the payment from there without paying any tax. The other difference I want to draw to your attention is the fact that an adult child is not considered to be a death benefit dependent. If a death benefit is paid to them, tax will be payable on the taxable components. When a super death benefit is paid to a death benefits dependent, however, for example, a spouse, a minor child, a financial dependent, or someone in an interdependency relationship, there is no tax payable, no matter what the components are that make up the death benefit. This is why there's such a focus on the taxable components as you head into retirement. A super death benefit paid to a death benefit dependent can be paid as a lump sum or as a pension. As you'll recall, super benefits can consist of up to three categories: tax-free, taxable taxed, and taxable untaxed. Tax-free components are always paid out tax-free no matter how they are paid or who they are paid to. Taxable elements, both taxed and untaxed, paid paid as a lump sum, are paid tax-free to death benefit dependents. Taxable untaxed elements paid as pension are taxed at the marginal tax rate of the recipient, less a 10% offset. If a super death benefit is paid to a non-tax dependent, which remember includes an adult child, it can only be paid as a lump sum. Again, any tax-free component included in the payment does not incur any income tax. The taxable tax element, however, will have 15% tax deducted, and the taxable untaxed element will have 30% tax deducted. If the super death benefit is paid directly from the fund and not via the estate of the deceased, the Medicare levy is also incurred on the taxed elements paid to a non-tax dependent. So this is why reducing your taxable components, particularly if you have a larger super balance that you envisage may pass to adult children, is something to consider between when you retire and while you can still make non-concessional contributions, as this can have a big impact where large super balances remain at the time of your death. If you have a particularly large super balance and also have taxable income outside of super, however, keeping money in your super fund may remain the best place right through to the end, from a tax perspective, at least. Now, if you have any queries, please add them to the Q&A or contact us directly. We'd be happy to assist you with a review of your situation. And finally, don't forget, we have another webinar coming up. On the 30th of April, Our last webinar in this series will look at all the contribution options available. It would be great if you could join us for that. Thanks for your time today.